G'day, folks. There is one conversation of choice in our household these days, and that, of course, is juicy passive income from those dividend stocks. As my parents head into their retirement, we are looking at a bunch of different portfolio assets, from ETFs to money market funds to obviously those wonderful high-yielding stocks that I want to review today. I want to kind of share with you what I think are of the most highest yielding. We're talking about 10% yields that are probably of the most sustainable moving forward during this crazy, rocky market. If that is a conversation you'd appreciate, as always, hit that like button, folks, because this whole entire dividend conversation is primarily coming from money market funds. In this interest raised, high risk environment, people don't look at a 3%, 2% yield like we were getting a few years ago on a traditional dividend stock. And this kind of market is safe, and they want to take that risk off the table and get maybe 4 to 5% off money market funds where they know they don't have to worry about anything. And that's a pretty reasonable return, right? But because everyone's pulled that money out of the market, now we're getting this risk reward question come into play. Now that we're seeing yields of 6 to upwards of 10%, that a lot of these can be sustainable. I mean, especially once we get through this kind of rockier environment, they look attractive, right? So now we're playing this debate, right? And what the inflection point is going to be for people. How far do stocks have to drop? How high do yields have to get before people stop caring about money market funds? Now, I believe these are a huge proponent to a portfolio today. I'll probably end up putting some of these in my parents' portfolio, like things like ZMMK, the BMO money market fund, which has been yielding 4.57% and is going to continue to do that for as long as interest rates stay high. And as the Canadian Treasury, the Canadian Bank, the Federal Reserve have been saying, hey, we're going to potentially have to leave interest rates higher for longer. In effect, we're probably going to have to even raise them one more time this year, and that's going to lead to further cash flow out of these kind of investments. But the problem with these investments, if you put too much money in here, you don't have a risk appetite. When they start lowering interest rates a year from now, you come back to me in 2 or 3 years, and all these crazy decade high dividend yields you're seeing, they're going to start evaporating as people go back into a more risk on, a safer market environment where everything is stabilized a bit better. But today has been a lot of pain, baby, and they're blaming it on, governmental shutdowns. I mean, the Canadian commerce has been all caught in geopolitical stuff with Ukraine, and there's a lot going on that I don't think has anything to do with the market, but they're blaming the market downturn on those kind of events. Really, I think this is just a cyclical trend after a wicked rally coming into this year. People are just taking profits, locking in gains into the end of the year. I just bought some S&P literally the other day, and I could have bought a better deal on it today, but I still believe these are great prices to start cost averaging into and continue to keep buying, of course. I'm hoping the end of the year continues to actually be down because I want to top my tax advantage accounts off. But speaking of governmental shutdowns and governmental issues, I want to share with you a little bit of humor coming from our chat group today. If you want to join the chat group, talk with me 24/7, 7 days a week, that Patreon member link is down below. And then we're going to talk about security and dividends and what's a good and bad dividend stock. But take a listen to this.
Hey, bro, since the 1980s, the average rent price done went up damn near 4 times. And the cost of food done went up like 4 times. Yep, that too. And the cost of every fucking object you could buy with money has also went up 4 times. Yeah, quadruple. That was the plan. And you see, that's fine and all, but the amount of money that we get paid to pay for all that shit ain't went up that much. Yeah, for sure. I know that was the goal the whole time. But why, bitch? Because we figured out 50 years ago that if we just build our great lives today on the back of the future generations, then we'll be dead or damn near finna die before we have to pay for any of this shit. And y'all just fix it. What the fuck? Bitch, what about the American dream? Yeah, sure. See, that was for us. We paid for the American dream that we lived in the past using the future that y'all living today. So we lived for it back then, and y'all gonna pay for it today. That makes sense? Yeah, it make a lot of sense, but bitch, you don't think that's fucking evil?
A little bit of satire, but let's get into this, folks, with first and foremost, the things that I'm avoiding like the plague, especially for a retirement fund, and that has got to come down to the real estate investment trust sector. Oh my God. Anything to do with high infrastructure directly related to floating line of credit, mortgages, those are the things you got to be very careful with. Even these high infrastructure companies in Canada like Enbridge, obviously like the banks, the telecom, because it comes into this scenario where they're going to hit an inflection point where these interest rates are going to start hitting their bottom line so hard they either have to start doing job cuts, refining the business, which is what we're seeing with things like Bell and Telus. But when it comes to REITs, they don't have the same kind of liquidity and tools within their business to refine the margins margins a bit, they have to literally just start cutting the dividend. It's one of the primary tools they're going to have capable to them. And then we're seeing that with things like Northwest Health Property. There are so many REITs right now that have been cutting dividends, getting slaughtered. And if you are buying REITs, make sure you're not overexposed to the real estate investment trust sector, especially if you own real estate. I told my parents that your biggest investment, where all your money is in your real estate. So don't over leverage into it. It's very risky stuff right now. And again, you're going to see these cuts probably continue. You want to look at REITs like Cap REIT, maybe even RioCan, companies that have already refined the balance sheet coming out of the pandemic and have the capability to survive the higher interest rate environment. But when it comes to stable dividends, as much as I hate the tobacco sector, you got to admit that the cash flow coming out of these companies right now is absolutely amazing. And I don't like MO. I'm just talking about British American here. It's one of my favorites next to PM if I had to pick. But the primary reason I hate these kind of stocks is because nobody buys them. And what do I mean by nobody? Nobody important buys them. The reason these stocks haven't gone anywhere in like pretty much since 2018 is because, basically hedge funds and big funds said, look, we have to follow ESG compliance and we gotta look good for our clients. We have to follow rules. And those new rules basically said we can't hold sin stocks, right? And if you take a look at the statistics, there's no better example of this. You go into British American Tobacco, you take a look at the institutional ownership, 7.98%. You want to put Apple in comparison? Nobody's touching these kind of companies. However, in a market environment like this, and because no big funds want to touch these companies, it makes them trade at such favorable multiples that if you are somebody that is retiring or needs cash flow, of all the other investment vehicles I've looked at, this is probably the most secure. I mean, take a look at this dividend here because, they've been paying out dividends. You look at the last 5 years, 63 cents, 66, 62. Today, they're getting into the 70s and holding that fairly consistently even through this crazy market environment. And they've got such a healthy balance sheet. And you take a look at the dividend. This is a historical high dividend. Right now, Macro Trends, it says it's 8.25%. Never in their history have they ever paid this much in dividends. It doesn't matter how far you go back. I don't know what was happening back here, but something tells me they weren't actually paying 130%. But this is the highest time basically throughout pretty much their entire history paying these kind of insane yields. It's kind of astounding, but can they afford it? That's the question, right? Can they afford it? But you take a look at the cash flow. What's the payout ratio? What do they say the payout ratio is on this right now? 44%. Oh my God, guys, 44%. You know how ridiculous that is? And then you take a look at the balance sheet here. If we just kind of break this down, their operating margins are 44%. Their revenues were up, 2.8%? Nothing too crazy on a year-over-year basis. But then again, you take a look at the revenue by new category. They're growing these categories pretty dramatically here. It's up 26%. Absolutely incredible stuff, right? So they're doing a good job at maintaining these balance sheets. I'm not really too worried about it because the tobacco sector, people are going to continue to smoke no matter what. But again, I don't like these for a younger person because there's just no growth. And dividends usually aren't the end-all be-all of return, but something tells me if you're retiring, British American Tobacco with its insane yield could definitely be a huge proponent. Not a huge proponent, but a reasonable one. So it's one that we're definitely looking at with that 8.3% yield, something that we'll be paying attention to. The banks aren't something I want to buy individually into retirement because it's just easier to get them in ETFs. And that way you don't have to manage them. I know I would do that as a younger person, but as an older person, when you're seeing things like Bank of Nova Scotia yield 6.83%, that's healthy, but because the other banks perform a lot better, you still want some capital growth. And Bank of Nova Scotia hasn't really offered any kind of substantial capital growth over things like TD or Royal Bank. That maybe their yields are closer to 4.5%, but you want to kind of get a combination of both, right? So we'll talk about some of these ETFs that I'm looking at because many of you know things like VDY, for example, the Canadian monthly paying ETF from Vanguard. Problem with that is it's highly concentrated just within the Canadian banks and the financial sector, making up like 50% of the entire portfolio, which again, I wouldn't make that an entire retirement portfolio either. That's not like the safest thing to be doing, right? So I've been looking at things like XEI to pair with VDY. XEI doesn't have the same kind of performance, but actually from what most people don't realize is year to date, XEI is actually green because of the dividend yield. I think it's actually trading up like 1% or something. If we take a look, 1.62% has been the actual return this year, which is pretty incredible, let alone the fact that the dividends have actually came out being increased basically in 2022, and they've been holding this 10-11 cent mark, which is higher than it's been in the past over the last 5 years, which is also great to see in this kind of market environment. If you take a look at the holdings, unlike VDY, you're not going to see the same kind of performance in my opinion because it's not as upper weighted, the best performing stocks, which unfortunately have been the Canadian banks, but you're getting an equal exposure to things like Enbridge, TD, Royal Bank, TELUS, and you're still getting kind of the same weighting, like 30% financials, not as concentrated, but it's higher concentrated in energy, unlike VDY, that's 50% financials, and I think a little less weighted energy. But again, it's more equal weight. It's probably a better thing to pair with VDY, or you could pair it with VCE. But if we're just looking for cash flow and high yield, I should point out that, did I not point out how much this thing is yielding? It's pretty astounding with a 5.27% dividend right now. You can put this right in there with VDY and get some incredible Canadian exposure, a damn near average of 5% yield, and get that sucker paid monthly. I think these are two incredible retirement stocks to own. But a lot of people keep asking me about some of these other stocks, right? Like HMAX. Like, would you look at some of these covered call ETFs? I have a love-hate relationship for these, because as a younger investor, I think they're terrible investments, because you don't get the same upside, but you can still experience all the downside with these. And you guys were asking me, can this one here, HMAX, actually afford the dividend? And honestly, it's not that they can't afford the dividend, it's the dividend's going to go down over time. As the market goes down, the cover call strategies are going to change here a bit. The kind of cover calls they're writing, you need stability in the market. Actually, it's better if the stocks don't go up a lot or don't go down a lot. That's when you get the best performance out of these covered call ETFs, because you can see they've already cut the dividend once. I would expect that if the market stays in this downtrend, they're going to cut the dividend again, because it's just what you're able to get basically from the options that are currently existing in the market, right? Because you can see here, like, they were generating a little bit more at the beginning of 2023, and as of now, it's already come down slightly. You can do all your research on these and see if you like them. Honestly, I'd prefer to write my own covered calls, but a 15.5% yield sounds astounding until you realize over the entire year, you pretty much lost the entire dividend income. So again, I just think you have to take that into comparison here, that when these banks start to rebound, you're not going to see the same upside, because many these covered call ETFs are writing 30 to 50% of the portfolio that are out of the money. But the problem is with this kind of strategy, it allows HMAX to generate a higher option premium while maintaining a 50% potential upside. So even if the market fully recovers, you're only going to see 50% of the upside. So you're going to get all the downside, but with none of the same upside, right? So even though you can get a 10-15% yield, it sounds attractive, but you're not seeing the performance, right? Like I said, if you're into retirement, these are something you can look at. I'm trying to avoid them personally, just because they're more managed. I prefer passively weighted funds over managed funds. For somebody that's younger, who's not going into retirement, if you're looking for yield, I want yield and growth. And I think Hershey's still looking at these stocks hitting 52-week lows. I mean, look at this thing. This thing just keeps it's down 25% now. It just hit a new, I think it's a 52-week low, but nonetheless, I mean, this thing's paying 2.23%, which in its history, I mean, 2.32%. The last time it paid it was basically coming out of 2018, 2019. It didn't even hit that, or maybe just hit it during the pandemic. But if you can get up to that 2.83% yield, man, I would buy Hershey every day of the week at a closer to 3% yield. But these are kind of the things we're thinking about as my parents head into retirement. But I'll pass the question off to you. I'd love to know what you think about this in that comment section below.